We're talking about HDFC Mutual Fund and why their funds have not been able to really show us the kind of performance that we're used to from that fund house. And we'll find out from Dhirendra what we should be doing about our funds. Dhirendra, thank you so much for joining us. Now, over the last 20 years, HDFC, AMC and their equity funds in particular have stood their ground as excellent performers. But over the last year or so, performance has been slipping. Now, HDFC Top 200 in particular, one of the biggest funds we have in the country, has been a laggard for at least 1 year now. Do you have faith that this fund will recover? Do you believe that it will show us the kind of performance that we're used to?
I'm a little hopeful, but future is uncertain, and so in that sense anything, and equity market is so much more uncertain. But yes, this fund has a very compelling track record. The fund manager remains the same. Last 20 years he has been right on all the key occasions. So I'm hopeful, but I think there are odds stacked against this fund. One, because of their scale, and the other is, the kind of environment we are in. It is, I don't know, it is also expectation mismatch. Investors tend to expect that these funds have done so well over such a long period of time that investors can't reconcile with even a mediocre performance for a brief period. And that is the case in case of HDFC funds. They are not very disappointing fund, but they are not outstanding fund, and any fund of this scale will not be outstanding all the time. So it is a matter of reconciling with it, and uncertainty prevails in the sense that the fund has attained a scale where maneuverability will be a little difficult, or the fund has been great at capitalizing on mid-cap stocks and that particular universe. That is increasingly will have a lower impact on the overall portfolio performance.
But let's also talk about HDFC Equity and HDFC Prudence. We're facing similar problems. Now, these funds tend to have a lot of overlapping portfolios as well. Do you believe that these two funds are going to recover with time and we should continue to hold on to them?
I don't know when they will turn around, because here a fund manager has taken a bet on a certain kind of stocks. They are certainly not the best performing stock in recent times. But at the same time, they are not the kind of small trivial stocks which will face a write-off. So I would say that I'm a little hopeful. But all the three big funds of HDFC are facing, because of the same underlying portfolio constituents, HDFC Top 200, HDFC Equity and HDFC Prudence. They tend to have the same bias, same focus, and that is impacting the fund, and they are disappointing relative to other funds' performance. And you have to live with this kind of uncertainty with any mutual fund which invests in equity.
All right, Dhirendra, we have a question from one of our viewers. Raghu has written in. He's an NRI working in the Gulf. He plans to settle down in India. He wants to know how much money he should put aside to get a monthly income of 50,000 rupees. He's considering the tax-free bonds, and he wants to generate an income of 50,000 rupees. Just investing in debt, is that something you'd advise? Should he also look at investing in equity, perhaps?
You have to look at your answer a little differently. That today you need 50,000 rupees. Next year you will need, assuming that inflation is 10% for your expenses, you need 55,000 rupees, and so on. So your need for this 50,000 rupee will keep going up by 10% every year. So you need rising income over time, and from that standpoint you need to approach your investments differently. To earn 50,000 rupees today, you need to earn about, assuming that you can earn 9% tax-free from the tax-free bond, you need about 60-65 lakh rupees. And that apart, you need a certain other component which will help, which should go about supplementing this income. And assuming that you need a supplementary about 20% of your capital, for that you need to invest an equal amount of money and maybe more in equity, so that you can supplement your fixed income investment from which you are deriving income. So that is the way to approach it, because tomorrow is fairly predictable. Year after year, going by what inflation is and what your investments will generate, and that apart, then your need for predictable, definite income every month, you need to split these two components.
All right, Dhirendra, many thanks for joining us on the show and answering our questions. Quick email ID on your screen if you have a question for Dhirendra Kumar.